Hi, I'm Siddharth Chandak,
I'm Saman Shrima.
and welcome to our podcast series I Don't Know. Saman, what is I Don't Know?
I don't know is our candid admission that we are unaware of many subject matters, but we're earnest in our desire to learn.
We aim to use this platform to interact with people from all walks of life. Essentially, we want to really understand how this little world we live in actually functions. We don't know.
That's why we're eager to know.
Being startup enthusiasts ourselves, we wondered what was the first thing we wanted to decode. Of course, investments in startups and venture capital.
So, for our first episode, we have the pleasure of hosting Mr. Rohit Krishna, who is the general partner at WEH Ventures. WEH Ventures is a prominent early stage fund that has supported a host of companies, from Small Case to Jar to Prathalipy and Animal. Mr. Krishna was formerly at Spark Capital and Moody's and now has been in the venture space for over 9 years.
In this episode, we really break down the fundamentals of venture capital. How does money come in? How does money go out? And how is money really made? Hope you enjoy the podcast. Thank you so much, sir, for having us here and being on the podcast, being the first guest on the podcast. It's a real pleasure speaking to you.
Yeah, it's a pleasure, and it seems like it's a lot of responsibility also being the first guest, but
Right, sir. To start things off, right, if you could tell us a bit about your own personal journey, where you grew up, what your education was like, things like that, just to get things started.
sure. So I was born in Chennai. I grew up in Chennai. For some reason, I moved 5 schools in Chennai. I don't think it was by choice. It just weird things happened, and then I had to change. But then I did my CA in Chennai, and unlike other sort of cities and states, you can't sort of pursue college and CA at the same time. So I went to Loyola for 1 year, but then I dropped off to sort of continue my articleship because I couldn't do both. Then once I finished my CA, what I knew was I was sort of interested in investing, but then it was a very sort of broad word at that time. I didn't have clarity on what within investing, and I confused investment banking with investing at that time, and just spoke to a lot of people, and then realized that probably can't get into investing right away, so there has to be sort of some roundabout path to get there. So that's sort of how I took my career. But then of course I ended up doing CFA as well,
Right.
because I realized that people value that in sort of a lot of investment jobs. So that's sort of what I did, and then I can talk more about what I'm doing right now and the path, but
Sure.
that's a bit about me.
Sure.
No, yeah, we'd actually like to know more about that. So just fast tracking to your professional journey, right? You were at Moody's, then Sparks Capital,
Yeah,
and then in some capacity at what you call Equity Crest,
yeah.
which was the precursor to WH,
Yes.
I assume. So can you briefly tell us what you did at Moody's and then at Sparks, and what was Equity Crest really?
Sure.
And to that end, how did you switch to VC? And you've been in VC for 9 years and 1 month, as per LinkedIn.
yeah, that is true. Cool. So see, when I actually passed out of CA, what I did was I wanted to get into VC. That was my sort of first goal.
And this is what year?
This was 2011.
Okay.
2011, and then but there were only very few funds. There was Helion. Actually, all the funds that existed then probably don't exist now, apart from Axel and Sequoia. and all
Helion
that.
exists as Arkham today.
Arkham and all that, yeah. But so Helion was a very good fund then, and I got a call back, but it was for the fund accounting role because they looked at me as a CA,
Right.
and of course that made a lot of sense.
Yeah.
But so I had a frank conversation. I realized that if you get into fund accounting, it's actually very hard to become switched over to the investment side. It almost never happens.
Okay.
So I didn't take that up. Then I remember writing letters. I can't just remember which firms I wrote letters to. I had typed or handwritten. I think typed most probably. And then I sent out, but then didn't hear back. So that's when I spoke to a lot of people from the industry, not necessarily VCs, but those who in private equity and those who are managing funds in public markets, saying what is the right path. Let's say if I can't get this, what other jobs can I sort of do right now, which could provide some value eventually for investing, right? And that's when I heard about credit rating, saying this is a good place to understand the basics of a business.
Okay.
And the great thing about this job was I stayed there for a couple of years.
This is where?
In Moody's.
Yeah.
In Chennai.
Chennai. Okay.
Yeah. And you get to evaluate like multiple companies in multiple sectors, like week in, week out.
Okay.
Which is damn cool. And again, like sort of the venture job, you get access to management at a very, very young age, like almost like probably 1 year older than what you are right now. You get to sit with the CEO and the CFO and just ask questions.
Okay.
And you can ask whatever questions you want, like basics about what is the raw material used for your industry, what is the manufacturing process. Yes.
Okay.
What is the manufacturing process like, who are the suppliers, what is your competition like, pricing, all sorts of whatever basic questions you want you can ask, and they'll be patient enough to sort of answer everything. And then the process was we had to write like about 15-20 page reports. Like this is like full long form text, no pictures, no PowerPoint slides, nothing, it's just text. And it'll be like a paper like this. And this is then sent to a committee of very senior folks within Moody's, who are like the sector heads of multiple sectors, like 5-6 of them. And they come on a conference call and you have to present your company to them. And present meaning they would have already got the notes, so they would have read the report. And each of them will just butt in with their question, and it used to be like 10-minute bursts for every company. And then it will be very specific questions, and you better know the answer then, because you can't go back to the management and sort of ask. At the end of that 10-minute, a rating is assigned.
Oh.
So that's how it works. So, and you have to go communicate the rating to the client.
Okay.
And if it is bad for whatever reason, etc., they'll also be pissed. And there's also a chance that if you do something wrong, you might potentially lose them, because there are 3 companies: Brickworks, Moody's, and Crisil.
Okay.
So they can just move to someone else or whatever. That's also the risk is also there.
Is that a thing now?
I think they're still there.
Okay.
They're still around in some form. So this was the process. So it was a very interesting thing for a young professional at that time, and I got to learn about very like a different kind of industries, from real estate to, I remember vividly, there was a cricket ball manufacturer.
Okay.
I mean, these kind of companies, because I'm sure they might not list etc., but they still need loans.
Yeah.
And for any company that has like decent sized loans, they'll have to get rated.
Yeah.
So this is cool. So I think I would have personally been part of over 100 companies rating. So that was the beginning. And then, but the process, the funny thing about this, the process doesn't change. So let's say you did this for 2 years. After 15 years also, my friends, I still have friends at Moody's, they still do the same thing.
Oh.
So those who love doing this, and if you feel like you like doing this, the good thing is the job doesn't change.
Okay.
You would have to manage obviously some team etc., but your core day in day out will still be this. It's just that the scale of companies that you meet will just get better and better, larger and larger, but the job remains. You still have to write 15-page reports, 20-page reports and present, and it's just that instead of presenting, you'll probably sit in the committee and sort of do that.
So you got that taste of evaluating companies very early on in your
Yes.
career.
Yes.
So how did that transition into Sparks and then eventually like WEH come about?
Yeah. So Spark was because I had the itch towards investing always, and this is not investing. Moody's is not investing.
What is Spark Capital, if you could give us a...
Spark Capital is recently their equity division got acquired by Avendus. So it had 2 divisions. One is investment banking, where they raise capital, IPO, all that stuff. Then it's the equity brokerage division, which is basically a sell side broker.
Okay.
So they provide research reports and also trading capabilities etc. for mutual funds and large listed private equity sort of players. And based on this research that Spark gives, they'll sort of route their trades through the Spark brokerage. Therefore, Spark makes money. That's any sell side broker.
Yeah.
So, I wanted to get into investing, and I knew Spark is also not investing, sell side is not investing necessarily, but it is one step closer.
Sure.
So I was like, okay, let me do my CFA. I did the, I think once I cleared level 2, I got a call, and then sort of interview was not too bad. So I took that up, and this again was interesting, but it's analyzing company from a different point of view. Here it's very specific to sectors. Like with Moody's, the sector sort of mapping was more fluid. Here it's very fixed, saying I was looking at automotive and auto anch listed companies, so 15-20 of them probably, and you'll have to make reports on every specific company, and also just on a sector, also, like every quarter what is happening, anything, like a differentiated point of view on the sector.
Okay.
What are the trends, etc. And this, mind you, this is all before EV and all the cool stuff happening in automotive. So, and there'll always be companies which are listed where we will not have coverage. So there you can initiate coverage, like you go speak with the management, everything, and then saying we'll cover you, we'll make research reports on your company, and
they're open to disclose stuff like.
Of course, because they're listed. The better mutual funds understand their company, the better it is for their stock price, right? So that is the third part of the job. But once you make these research reports, and then you will have these quarterly earnings, etc., you will have to make those notes also. But the point is, all this information is to be sold to a mutual fund or a private equity fund which is investing in listed stocks. And therefore you'll have to call folks and then speak to them. This is again before Zoom.
Okay.
So you'll have to call them and saying, this is my point of view, etc., etc. Sell your research, and then say, I'll send you the report. They might have questions. You can send them your models. So, like the name suggests, it is actually sell side. You have to sell your research. It's not that you can do the research and then saying, like, buy it, or you can't. There is no value to your research report unless trades get routed through you. So it's a little bit of research and a lot of selling. So I spent 2 years doing that, but the obvious path, this is again still not investing, right? So the obvious path out from here is either a mutual fund or you get into some private equity fund investing in listed like a Premji, etc. Right? So I did when equity crest happened, and also I realized this is also, Spark is also in Chennai. Spark is primarily a Chennai based firm, but they now have offices in Bangalore, Bombay, etc.
Okay.
But I wanted to get out of Chennai because there's only, like, by the time I'd probably interviewed to all the financial services firms in Chennai, like 5-6 of them.
Okay.
And so the exit was sort of imminent. So that's when equity crest happened. It was just a LinkedIn thing. I was speaking to Deepak and then trying to understand what this was, because after the initial letters that I wrote for VCs, I'd forgotten about it. Like that was not necessarily a focus for me.
Okay.
I was thinking more and more on listed and mutual fund. At the same time, I was in the last round interview for Franklin Templeton, the fund. And that was going through, and then I flew to Bombay and then met with Deepak and Amit for equity crest. And in the interview itself, I think, like you said, the precursor for the fund. The equity crest is basically helping young startups raise their first round of capital. So at that point they were raising sub $1 million as the first round, and the market was not necessarily as evolved as it is right now. So you still needed connects, you still needed someone to vet your.
This is what year again? We're talking about which?
2015.
15.
Okay.
And you had to vet your deck and everything. So we did that. We made those connects and we helped these companies raise capital. But the problem is, this is still investment banking, and you don't make a lot of money doing this, because if the company itself is raising only 3-4 crores and you make 2% of that, then what is it? I mean, it's not a business. But this was an entry into understanding the ecosystem. This was an entry into understanding what companies are interesting and why are they interesting. Like for me and also for Deepak, he was coming from a growth stage investing in venture, which is very different from early stage. The lens changes a lot, right?
Okay.
So 2015 and 16 is when we just helped companies raise capital, and we are also trying to evaluate for ourselves as to whether this is, we are good at it or not. If I was not good at it, I'll go back to mutual fund. That was my sort of plan.
Equity Crest at this point was just facilitating pre-seed transactions.
Yes.
You weren't involved in anything.
Involved in the sense.
You didn't put your own money.
No.
You're just
No.
connecting the VCs
Yes.
with the
Yeah.
companies. Right. Okay.
I think we invested few lakhs in some companies, but it was like almost nothing. So it didn't mean anything. But yeah, during the interview itself, they also spoke about the fact that they want to launch a fund. That is, this should lead to that. Just didn't know how long it might take. Whether it took 1 year or 3 years or 4 years was not clear. But I took the punt. One, it gave me exit out of Chennai, and by then I also had a girlfriend in Bombay, so there was another reason to move. And second, this was getting again closer to investing, but mind you, still was not investing. But there was at least a clear shot at probably launching a fund. And what I felt was, after Spark, the quarterly cadence, and even in a mutual fund like a Franklin, etc., you get allocated to a sector and you become a specialist of one or two sectors, and therefore the deeper you get, the harder it is to get out of that sector. So if you're an auto or a chemical specialist, you will continue doing that for 15-20 years. It felt daunting for me at that time that you're choosing a path. It's not like I chose auto. That was a sort of sector available then. Now Franklin, I don't know what would be available, but then let's say it's cement or something, and then you're not interested in it, but you have to do that for 20 years. It didn't seem very smart decision to me to take that early on. That's why I chose this over that, saying okay, this could be probably more interesting in the long run if you're good at it. So that was my thought process, and I took that punt, and sort of that converted to WEH Ventures. In 2017 we launched our first fund, in 2020 second fund, and now the third fund. So sort of stuck on for 9 years, 1 month, like you said. So.
And I'm curious to know, WH stands for Western Express Highway, and I don't think a lot of people know that, no?
Yeah, because we don't say it out anywhere, and for those who are not from Bombay, it's even harder to even guess that.
Figure out what it even means.
But
because when someone just telling me, I was like, wait, what is Western Express Highway?
Yeah.
But why, and like, is there any rationale towards naming it that?
Yeah, see, if you look at US, like Sequoia as a tree, Union Square Ventures is another fund we used to really try and emulate, and we're quite looking up towards. That's also an area in US and New York actually. So then we were thinking, okay, we are based in Bombay, offices in Andheri East. We were living close to Western Express Highway in Andheri, so we're like, okay, what areas in Bombay can you think of? And Bangalore was not necessarily a thing because we are not from Bangalore, both Deepak or me. And so we think of Kolaba, WH. But then WH was good because it was obscure in a way that people not from Bombay will not get it, but people within Bombay will get it. Similar to actually USV. It's again 3 letters. Those who know Union Square will know Union Square, that it is a spot in New York. But if you're not from New York, it's just USV for you. So it sort of worked in the same way. So. And we don't, after that, unless someone asks like this saying what does it stand for, we don't explain it necessarily.
Oh, okay. Well, that's cool. That's a pretty interesting journey, right? Like getting into this at such an early age and then taking the risk of starting something, that's pretty cool journey. But so like now we really want to dive into WH specifically, right?
Sure.
And how VC works in itself. So when we were thinking about it, in very simple terms, we divide it into 3 parts, right? How does money come in, how does money go out, and how is money made in VC, right? So when we speak about how is money coming in,
sure.
When you're going to your LPs, like firstly, how are you finding your LPs, and what is the USP you're presenting to them? Like what is WEH's USP to them, WH's USP to them, compared to like there are so many early stage funds right now. What are you telling them that the others aren't, and why are they trusting you?
Got it. Yeah, see, it's different when we started out and it is different now, right? Like when in 2017, and raising your first fund is always the hardest as well, because you don't have a track record. It's mostly like we say for startups, it's your friends and family kind of round, right? Because only they'll trust you.
Yeah.
It was like that. It was a lot of Deepak's connects, and then his friends and CXOs that we knew who were in sort of decent positions in their late 40s, early 40s. And to your point, there was no USP, nothing required at that time, because most of them were investing in venture fund for the first time.
Okay. This is 2017.
2017.
Okay.
And prior to that, their capital was mostly allocated to real estate and public markets, etc.
Okay.
So we didn't have to compete with anyone else.
Okay.
It was just whether they'll put money in venture or not. If they did, we were their sort of first choice,
Okay.
because it was a closed circle. And these were mostly CXOs and HNIs, not necessarily large institutional family offices. So that was then. But if you sort of how we get money part, right, I'm talking about, like now, the market is obviously much more evolved. There are a lot of venture funds which are there in the market. There are a lot of deals which get announced very often. And family offices have sort of gone through this bull and bear market now, right? And they also understand, so they have teams sometimes in-house. So they've taken a more institutional approach to managing their capital, venture being one asset class obviously that they're investing in. So now the USP etc. matter a lot more, and luckily for us, we are not raising our first fund now. And therefore we don't have to talk about our edge and USP on day one. We have our past performance etc. and we're raising fund 3, so it actually should be easier to do it. But see, I think there are 2-3 ways to think of USP, right? Like you said, what can you do? You can either, like I gave you the example of public markets, you can choose a sector within venture also, saying I'll do only consumer brands, I'll do only fintech, I'll do only deep tech, whatever. That is one way to differentiate. The other way to differentiate is actually saying the number of deals that you do within a fund. It could be 20 or it could be 100. Now whether you do 20 or 100, you can have your own thought process and reasons for doing it, and that in itself could be a differentiation, and depends on the LP what sort of which format they like as well, right? And apart from this, it could be your unique network. Let's say you're a sort of product manager or VP from Facebook. You might have some cool networks, or you are an early employee in Ola. You might have some cool networks now, which could be valuable. That is the third point of the sort of differentiation that you can pitch, saying because of my network, founders when they start out, they'll come to me first before going to anyone else, and therefore I'll have first access. But beyond this, it's everyone does the same thing. You take money and then you invest in companies, right? So it's like how do you differentiate a PMS? How do you differentiate a mutual fund? At the end of the day, they all do the same thing. Beyond a point, I think the brand and the performance will start to matter more and more, rather than having to show a differentiation. And we've not, for example, taken the first approach of focusing on any sector. We are a sector agnostic firm, and the reason for this is you can never say whether fintech is going to be hot or not at a particular point in time when you have to invest. Let's say we have to invest this year. I don't know whether there will be a lot of fintech opportunities this year or not. And if I'm a fintech fund, then what am I going to do? I can't sit tight not investing also, because I've already taken money from LPs. So I will have to invest. And the second point on sort of number of companies, we have taken the smaller number on 20 to 25 companies per fund. And that's sort of our approach. There is again no right or wrong to this. It's just the way we work. And in terms of the unique network, given our backgrounds, etc., it's more an organic sort of approach for us, right? So there is no, Deepak is from IT Bombay, etc., but that's not our USP. Our USP is the fact that we've been able to find some very cool companies at very early on in our sort of Fund 1 also, and Fund 2. In Fund 1, we didn't have any reputation or brand for WEH itself in the first place. But our second investment was small case. So we did some things right, and that's sort of our story right now, saying we've done this in the past and therefore we can continue doing this, hopefully better than what we did before. So
So in the first fund, when you say you raise money from CXOs, HNIs, how much of this was your personal network, say from the Moody's people you were speaking to at Moody's?
No, none.
So
Zero.
where did you get this connect of these HNIs, these CXOs?
See, Deepak is much older than me, so it was a lot of his connects in the first thing, and then because we ran Equity Crest, we got some connects there also. So what we used to do in Equity Crest, which I missed talking about, is we also help these companies raise capital from angels. Those who were already invested in startups and ventures, HNIs. So some of them, when we launched the fund, ended up investing in the fund because we had built that relationship. But those who are in Moody's, etc., their risk appetite for investing in the asset class is very low. I still do not forget fund one. Even now, if I go to them, they might not invest in the fund because their risk appetite is very different.
I also want to understand one more thing from the LP perspective. How many repeat investors do you have, say, from Fund 1 who participated in Fund 2 and Fund 3?
So, Fund 1 to Fund 2, I think about 60% of all Fund 1 investors end up investing in Fund 2. But Fund 1, the average check size they had to invest, and these are all SEBI mandates, just the class of fund that we chose, that was 25 lakhs. Spread across, let's say, 3 years.
Also, which class of fund is
this? Is Cat 1 subcategory angel fund.
So can you break that down for us, right? Like,
sure.
In simple words, if like what categories really stand for, and how say a VC or early stage fund is placed in that.
Sure. So there is category 1, category 2, category 3. Category 1 is ideally for early stage venture capital funds. Category 2 is for private equity and large growth venture capital funds. Category 3 is hedge funds. Category 2 has flexibility to invest in both public and private. Category 3 is more for when you take leverage in futures and options and all, so it's more listed. And category 1 has a subcategory called angel. The only difference being is the minimum check size from a LP is 25 lakhs for the angel subcategory, whereas for the main category 1 fund or category 2 or category 3 it's 1 crore. So to your point, the reason I brought that up is like, so the 60% of investors actually invested 4x the size that they invested in Fund 1, in Fund 2. And so that again formed a decent base for our Fund 2, and then we got some new investors also, larger investors, etc.
And how many investors from prior funds do you expect will participate in the third fund?
So hopefully, right, like a lot, like I think now the stage of Fund 1 we are at right now, we are in the process of giving exits to our investors. So we've returned about 40% of the capital already in the first fund. Now we want to get it to over 100%, meaning 100% of the capital that you invest you get back. So once they get that back, then they'll be more comfortable to sort of plow it back into our third fund. Because like I said, a lot of them are already invested in Fund 1 and Fund 2. So they'll need some capital back to rotate it.
This is only the capital, not the...
The returns also, we can exit a lot of our companies right now and give it, but you'll have to let your winners ride also, right? And this is, I think, even more true for venture rather than even public. You would have seen that, like hold on to your winners in listed, right? But here it's even more true because there's no re-entry possible.
Correct.
Let's say you invested in Eicher Motors early on and then you missed it, you sold it, you took some profit, you can always re-enter. Here it's not possible. So if I sell all the shares that we hold in small case, we can't re-enter the company. And the point is, after 5 years or 6 years of investing in a company, you know which are the really good ones and you know which are the ones who have not performed well. And what happens is, for the companies which perform really well, the various risk factors keep reducing. The risk doesn't increase necessarily because from a size you're much bigger, you have a much better team, regulatory risks are lower, product risks are lower, brand risks are lower. And if you sell at a point where because the risks are lower, it's just about scaling, and they still end up growing much faster than 100% year on year. So whatever IRR metric you can think of, it will still be really good to hold on to it. And that's why and we are also learning this on, like, as we sort of go, right? Because our first fund is now reached a point where it's towards the end of fund life, so we have to think about exits, etc. That's where we are realizing that your power law, like how much ever you read, unless it actually happens, that's when you realize, okay, what this power law means, and therefore you'll get these 1-2 big winners, and then you'll have to hold on to them as long as you can, so that you get the best sort of return for the overall fund.
So just drawing on that point further, right? When we speak of fund life, say firstly, is there a fixed fund life of 8 to 10 years that most VCs are playing in? And then when it comes to exits, right? Do like say some of your investors may not want to participate in the second fund.
Sure.
And they would want their capital plus return.
Yeah.
Right? And some wouldn't, and some would want to reallocate their capital to the next fund. How does that mechanism really work? That how much time do you stay invested for? When you give your return back to the investor, how does that essentially work?
See, okay, so we draw like the 25 lakh or 1 crore that I spoke about. We draw that first of all within 3 to 4 years.
Okay.
It's not at one shot.
25 lakh you're drawing over 4 years.
Yes.
Okay.
Or 1 crore over. Whatever you as an LP you want to invest in a fund, we'll draw it over 3-4 years.
Okay.
And we invest. Those first 3-4 years of a fund is to invest, and ideally shorter than that. It should be lesser than 3 years.
Okay.
The reason for this is the fund life typically is between 7 to 10 years.
Okay.
Assuming no extension, and usually all funds will have an extension clause of plus 2 years.
Okay.
So it will be either 7 plus 2 or 10 plus 2 max. There are funds which are longer also, there are funds which are shorter also, but those are exceptions. The maximum fund will be within this range, and therefore if you have to exit a company in 7 years, that means if you don't finish your investments within 3 years, you don't even give the company 4 years to sort of actually perform and grow. Therefore it's very less for the last tail end of your portfolio, and from whatever we've seen in the market, it takes just 2-3, like imagine you're starting a startup now, and then I come and tell you after 1-2 years you launch a product, you're getting some early traction, revenue, etc. But after that couple of years, I'll be like, I'll have to exit. There's no way I can exit, because you'll not be at a stage where you're large enough to have attracted capital to go secondary. You're clearly very far away from an IPO, so exit mechanisms don't work. So ideally, if you ask me, in my opinion, like I think 10 years is required. You need to give a company at least 8 years to mature. The first 3 years will be to figure out whether the product is working or not. Then next 3 years is actually scaling revenue, etc. Then the last 2 years is the mature phase where you can get liquidity on tap, provided the company is obviously good.
Correct. So we're taking a fund life of say assume 10 years.
Yeah.
The first 3 or 4 years is to deploy the entire capital, and then the balance is just for the company performance and exiting.
Yeah.
Okay.
So let's say when you're exiting at year 10, right? Now, what if for some companies you aren't finding other investors, or the company is not willing to buy it back, right? Like, what do you do then? Like,
You can't do much. That's the whole.
You just sit.
Yeah, you see, you can't, like, it's like you want to sell a second-hand sofa that you have in your house, but no one wants to buy it. Then what do? You can either throw it out, like US, they just throw it out the window and then keep it on the road and come back. It's I'm not saying it's like that, but it's like you can't do much. You have something which you feel it's an asset, but unless someone prescribes a value to it, it's not worth much. So there are multiple ways to think of this. If there are 2-3 sort of sections, right? Like how the company can sort of perform. Either they perform really well. If they perform really well, you will find buyers. Or second, they perform really badly. If they perform really badly, the best outcome is to just sell the shares to the founders. Saying it's your company, so you can buy back the shares at 10 rupees, 100 rupees, whatever. And you run the company the way you want it, or if you feel like it's this sort of not working out for you as well, it's not worth your opportunity cost, shut down the company. That's the second option. Third option is where it gets more tricky, where it's not like they're sort of hitting it out of the park, but it's not like they're doing so badly either. In these cases, it's a lot more tricky, and it depends on what the founders also want to do. Sometimes they really want to continue building on the company. Sometimes they might also look for an M&A kind of option. Then together you can work towards getting a decent sort of M&A outcome for the company. But if they don't want it, then we'll have to find secondary buyers for our shares, and you will just have to do it a lot more. Like it will require a lot more effort from your point of view to sell your shares. That's all. But there is no other way to this. There is only these 3 options.
So before we continue, could you just adjust your mic? I think it's moving over there.
Just put it lower on your collar, I guess.
This?
Yeah. Yeah.
Are you sure I won't fall out?
Yeah.
So just put it probably here. Yeah. Works. So like now that say you've collected money from your investors,
One thing that we've been noticed across VCs around the world, right, is super lean teams.
Yeah.
Right? You have like max 10 people managing $1 billion. In your case, 4 people managing 115 crores. How are VCs maximizing for productivity and efficiency in such small teams, and how does that really work?
Sure. See, I think it's not a function of the money that we raise. It's more a function of the number of companies that we invest that money in.
Okay.
Let's say for us, our case, it's about 20 companies per fund. Now we need to invest and find 20 companies first of all. The second is after you invest, you will have to have a relationship, understand what's happening well or not so well within this portfolio companies, and sort of guide them in whatever way you can and help them in whatever way you can. And for that, you need some bandwidth to work with the company, right? So that's how we look at it. So the team of whatever 4 people that you mentioned, it's to see whether these 4 folks are enough to find 20 good companies and also enough to work with them for the next few years. Okay. And the 20 will also keep reducing, meaning either they'll scale to a series A and B stage where our role will become lesser and lesser, or the product itself will not work and therefore they'll shut down. Okay. In either case, the 20 will become 10 in a couple of years. That's the sort of natural way of progression. So we can add another fund and then, by then invest in 10 more companies from the new fund, right? And therefore together it will again be 20-25 companies to manage. So that's how we see it, and how much AUM you have is immaterial. Okay. For the first fund, it was just me and Deepak. So from saying to figuring out the investment thesis to actually investing and helping the portfolio, everything was sort of just the both of us. And now the second fund, we have 4 of us. The third one, probably we might hire 1 or 2 more people at most. But yeah.
So these 20 companies is because you have 4 people. If you have more people, you might invest in more companies.
Not really, it's the opposite. Because we have decided the number of companies, then we figure out how much.
Why is that? Why we decided 20 companies only?
So see, why, like, see, the interesting part to the answer when I said 100 sort of companies per fund or 20 companies per fund, and you have obviously multiple points in between. There is no research or data driven sort of statistics to prove that one approach is better than the other. See, there are 2 approaches, right? Whether you invest in 100 companies or 20 within a fund, and then there are multiple points in between. There is no data to prove that investing in this approach or that approach is better. So therefore it's more a personal choice of what you believe in. What we believe in is every company that we choose to invest has to give us an opportunity to return the whole fund if it succeeds, if it does well. And what I mean by this is like our equity after dilution, etc., after 5 years, 6 years, should be worthy enough that the whole fund is sort of taken care by that single portfolio company, assuming all the other companies die.
And in fund 2, what return would that turn out to be?
What return? It's the same thing. The concept is the same. Basically, when I invest in a company, whatever stake that I start with, whether it's 5%, 2%, 10%, that after 6 years, 7 years should be worthy enough to cover like the whole fund size. In the second fund case, that'll be 115 crores.
Okay.
So if I own 10%.
So ideally 20x.
Yeah.
Okay.
Correct.
So you want 10% of your target to cover the entire.
No, I'm saying every portfolio has different market opportunities,
sure.
right? Let's say a consumer brand, your maximum valuation is 2,000 crores.
Okay.
Just for simplicity, that means I need to own 5% of the company in the year of exit for me to return the whole fund.
Correct.
But let's say it's a fintech or some other opportunity where the possibility is getting to 15,000 crores. Then I need to own much lesser of that company to give me the same outcome.
Right.
But the point is, my entry stake along with the eventual market opportunity and the size, whatever we think it might be, has to return the full fund if it succeeds. This is one. Yeah. So where I'm coming at is the point of being choosy in your investments. Like we are very, very selective in how we sort of invest in opportunities, and also we invest more dollars in every company just because we invest in lesser number of companies.
Okay. So for
So-
follow-ons, you have to participate
Yes.
too.
So small case, for example, 15% of our fund one, 15% of the entire AUM was in small case. Whereas if you invest in 100 companies, at best you can invest few, like 2%, 3%, 5% in a
Correct.
company. So that's the difference. So we feel it's actually very, very hard to find a home run. And therefore, if you do find it, it's just smarter to put more and more capital behind it. Imagine you found Uber early on or Facebook early on. Would you just forget that, saying, okay, let me not invest any more money in this because I need to find 90 more investments? Or would you just take all that capital and just put it in this one company because you found a really, really amazing opportunity? So that's the point. So we feel it's actually extremely hard to find that one or two opportunities. So if you do find it, it's better to double down, and also it's better to have a very, very high a selection rate or a criteria, so that you don't invest in companies where you're on the fence.
Okay.
If we are on the fence on an opportunity, it's a no rather than a yes for us. Whereas for, let's say, someone who's investing, I'll talk about the other approach as well. When you invest in 100 companies, the thought process there is you don't know what is going to be an Uber, or you don't know what is going to be a Facebook. Therefore, it's just better to increase your surface area and invest in 100 companies. So the chances of one really breaking out is higher. That's the other approach. Where if you're on the fence, you say yes rather than a no. That's the difference.
So, but in your case, when you're early stage, right, under VC, which is already a risky space, you've
Yeah.
chosen the most
Yeah.
risky part out of that.
I know.
Why would you not go for, again, that 100 approach there, right? Because
You call it spray and pray, no?
Yeah, in a negative connotation, spray and pray. Yeah.
Oh, negative.
Yeah,
Okay.
yeah. For some reason within venture, it's a negative connotation.
Okay.
Spray and pray.
So, why would that approach not work out better for you compared to this approach?
It's interesting. I've also been thinking about it. I don't think there is a like I said, there is no data-driven approach to say that is better or this is better.
Okay.
But from a logical point of view, I'll tell you what happens is when you have to invest in 100 companies per fund, and I told you like the fund investment period is 3 years.
Yeah.
That means 30 companies every year, right? That's almost one every 2 weeks. Therefore, the pressure of investing is very, very high. So what might happen, and we've reached a point in our ecosystem where there are a lot of startups.
Yeah.
It's not 2015 or 16 where there were very few startups. This whole thing itself was not but now there is enough buzz, enough number of students dropping out, or when they just pass out they want to start something, etc. So it's very easy to invest in 30 companies a year. But can you invest in very, very high quality 30 companies per year is the question, which in our opinion is not necessarily that easy. And the minute you sort of lower your standards a little bit, it's super easy to fill this 30 spots.
Yeah.
But how do you know that you're not lowering your standards and the standard is still high and you're investing in very high quality 30 company? And for that, you will need to have incredible sourcing on the top, that so many founders reach out to you and you get to see so many founders, because like you said, it's early stage. What happens for a Series A or Series B fund is they already know what are the seed funded companies because it's out in the market.
Correct.
There are databases which track it, etc.
Okay.
And they can talk to funds like us saying which are the best portfolio companies of yours, etc. But for us, there is no such precedence.
Yeah.
So we are the first institutional
You're
investors
talking
in a
about,
company. Yeah. So therefore, you will just need to have some incredible network, or you'll need to do something very, very unique for you to get amazing companies knocking at your door all the time.
So, what are you doing that you're getting?
For us, it is just, I think, because we've been around for now 7 years and 9 years overall in the venture ecosystem, like those flywheel is starting to work. Like some of the early founders where we invested in, the companies did not work out, but their second company is working out a lot better. Or the founders who we invested in did not work out for whatever reason, but we have a great relationship with them. They are referring other friends and founders to us now. So it's a more organic approach that the network builds. It cannot be blasted through, because at the end of the day, all VCs just give capital. So you have, and I think this is one misconception, that let's say you both start a company now in 1 year or 2 years. would you want capital quickly, or would you really try to optimize who you get on the cap table or who you get as a fund? You don't, it's not logical for some, like it's the same thing for us as LPs, right? What do we look for in LPs to give us money? Do we need the best sort of networked LP or LP with the best brand name? Probably not. If someone gives us money quickly, we'll take that. Same thing for a startup. If you get a fund who wants to invest in you, if it's a decent ref check, you do it. Unless they're very bad, you'll probably end up taking their money. So it's about being the first person a startup, like at least the first top 3 VCs that a startup speaks to. And if you're able to get into that, you can. But it's not possible that you can get into the top 3 for all companies, or even a majority of the companies. Forget all. So therefore, it's more an organic approach of your network. Now, the 2 of us had built some network over the past 7 years, but now we've hired 2 more people. They bring their own networks, and they have different backgrounds.
Yeah.
They have different friends who will speak about to their friends, right? And they might do something unique. They might create a community, something else, sort of to just build this network. But it's all about like building your own unique network, apart from doing everything else what you can do online, because that is common to everyone. All funds can sort of search online and figure out.
Yeah.
So, but that's about it.
Yeah. So when it comes to your evaluation process, right? WEH has invested in so-called category creating companies. You look at Pratilipis of the world, Animals of the world. Today, when you're evaluating a so-called category creating company, at least I look at it, there's a very fine line between something being actually category creating versus someone solving something that actually isn't a problem.
Sure.
Right?
Yeah.
How are you evaluating then? What are the checkboxes that you're looking for at that stage to say, okay, this might actually be category creating?
See, like someone like a Pratilipi or Animal, right? Like the category creation question was fairly easy to answer because there was just no other product. Like when Pratilipi was launched, all content online was English. And we knew that cannot be the trend. Like, if more and more people start using the internet and consuming content, it has to have relevant content for them.
Yeah.
That was our broad thesis. Yeah. Animal, we're the largest sort of cattle breeding nation in the world. And everything still happens through Pashu Melas, buying and selling of cattle. There was just no transparency on pricing. But at the same time, in most of the cases, it was the biggest asset held by the dairy farmer. Because each of these cattle, like, guess how much a cow costs?
3-4 lakh.
Yeah, it starts at 90,000, but it can go up to any number depending on the breed, etc. Right? And so it's a large amount of money. So, but it is still happening very offline, etc. So, someone just trying to start something here itself is so rare because founders don't think of this as a problem. But she realized it's a problem because her father was also a dairy farmer. So she's sort of grown up with this and knows what the problems are. So it was a very easy sort of question for us as to whether this is a problem or not, and therefore there's potential to create a category here. On the other side, small case. It's not very obvious to think that investing is a problem. Right? Because you have some money, you like public markets, you can put money into public markets in multiple ways and forms. And at that time, there was Scriptbox, there was Funds India, and all these sort of platforms where they spoke about saying which is the best mutual fund you can invest in. And they used to guide and sort of put money in certain funds. But we didn't think that is defensible a lot because, first of all, no one knows which is a good mutual fund, which is a bad mutual fund. It's all based on past performance. You can't predict the future because you're not actually talking to the fund manager and understanding what his views of India is for the next 10 years and then taking a call. You're just looking at past volatility and performance and then saying this is a better fund, this is a good fund. Those were the only products out there in the market then. So what we did was, so there are categories where there are no products like Pratilipi and Animal. There it's an easier call. We decide very quickly. Correct. We invest. Then there are categories like small case where there are a lot of products. Some have worked, some have not worked. We don't decide very quickly. We don't invest in the first company that we see. Before small case, we evaluated at least 20-25 companies very seriously within wealth and savings for India. Okay. And there is when we realized how do consumers react to different products. And to your point on whether something is a problem really or not, we sort of figured out because the retention keeps dropping for a product where it's not a real problem. You might spend a lot of money in acquiring that user, but they won't retain on your product unless it's a real problem.
Okay.
So that's what we realized for a lot of companies and a lot of products early on. Whereas for small case, it was the opposite. It seemed like a sort of a very unique product or a niche product, but those who were on the product just kept increasing their investments through small case.
Okay.
So the opposite was happening. So by the time we tested this out and then we reached out to the founders, within a week we ended up deciding to invest in this also. But the precursor to that was actually evaluating and declining multiple companies in the same space before saying yes to a small case.
Okay.
So to my previous point on just the selection bias being very high. So if I had invested on the fence company, there were 2-3 companies which we were on the fence on. We could have invested in that, but that might have prevented us from investing in small case.
Yeah.
By the time we got to small case.
Yeah, opportunity.
So that's and you wouldn't want to invest in competing products, right? Neither will your portfolio want you
Sure.
to invest in competing products. So, but yes, so in spaces where it's already known and there are some problems which are already being solved, we take our time to evaluate the space and then invest.
So I just want to know, we're talking about VC here, right? How is VC valuation different from, say, if you're evaluating for any publicly listed companies, or on the other side of the spectrum, say private equity, which is further up the funnel as compared to VC?
Yeah.
So how do you, as an investor, what different characteristics do you have? What different mindsets do you have? And how is the evaluation process in all really different?
Sure. See, so when I say VC, we'll probably talk more about the early stage VC, and the growth stage VC is very similar to private equity.
Sure.
Anyway, and if you start from listed, I think the obvious thing is 2-3 points of investing, right? Like one, do you know what is the universe that you can invest in? The second is, can you evaluate this universe in some form or fashion? Third is the price, or how important is the valuation, etc. that you get in. Assuming these 3 are the important things which are common across all 3 classes. For listed equity, you know the universe, you know all the listed stocks. Second, you have data on all the companies, whatever, at least online, annual reports, etc. Speaking to the management, probably not possible for everyone, but you can still see videos about the management speaking. You can go to an AGM and actually do some research, etc. Right? And the third is the price and the valuation. Here again, all listed sort of market participants are price takers. You might think Bata should be valued at some price, but just doesn't mean the price will come down to that. So what you can do is you can decide on a price and you can wait till saying, if this cuts this, I'll buy this. So these are the simple things, right? So it's not about being creative. It's about understanding who is managing their company really well, and also are you able to get that at a price which you think is right for that company. That's it. So it's more numerical. It's more there's a method to the madness, and then you can do your own research. You can do this research without even having to speak to anyone.
Fair.
And you can do a very, very good job.
Yeah.
If you look at, let's say, we'll probably cover private equity and then come to venture early stage. Private equity or growth stage venture, again the universe is known. All the companies that are seed funded, etc., you can list it out in an Excel. There'll probably be a few hundred companies.
Okay.
So if you are a Series C investor, you can just look at this list, and you can, again, the second point on data, it's not as easily available as listed.
Yeah.
But it is possible to get. Now, if you're a growth stage fund, if you go to a company and saying, we would like to evaluate you, 7 out of 10 times they'll probably give their
Most of the
deck
data.
and data, etc. for you to evaluate.
Okay.
Third is the price. In most cases, you're not a price taker. It's more of a negotiation. So there's like a 50-50 sort of power on each side, both the startup as well as the investor. And therefore, unless it's very, very competitive, you'll most probably get the price that you feel is the right price for you to enter. So it's very similar to listed if you see. because again it's very numerical. There is a lot of data for you to consume, and you can evaluate it. You can get to a price. You can do all your modeling and then figure out a price to enter. Because the reason for this, it's similar to a listed, is because your eventual exit as an investor is to the listed market, is an IPO, and therefore you will have to think backwards from what public market investors will value this at, how will they evaluate this, and then you do the same thing with a slightly different lens. Coming to venture, it's a completely different sort of jungle, because it's very different. None of these three things are the same, right? Like the three questions that I spoke about. The universe is not known, there is zero data to evaluate something, and third, the price doesn't matter what you get it, because you're talking of finding a company which can sort of just scale 100x, 200x from when you enter. And therefore, whether you enter at a 20 crore valuation or 50 crore valuation doesn't matter. Now, of course, if the 20 crore is it a 200 crore valuation, that matters. But within a range, it doesn't really matter. Even if it is a 50% higher number, 70% higher number, it doesn't matter. Universe is also not known. So, because the universe is not known, you need a lot of creativity and sort of serendipity to just figure out where is the possible opportunity. First of all, what is the possible opportunity, and second, how do I find someone who is building in this? So there is a lot of unstructured behavior. Every day of yours has to be a little different. Like the reason I'm doing this also is to open up paths of serendipity, right? Like whereas for public and private equity, all this is not required, because there is very steady way of doing things. And the second one is sourcing, and the second even evaluation. You need to be able to imagine a possibility for a company even if the founder themselves are not able to articulate it to you in the right way. They've built one product. Now how could Pratilipi monetize? When we looked at it, was not a question that the founder was also answering very clearly. But we took the leap of faith saying, if they do XYZ things in the next 3-4 years, they will eventually be able to get customers to pay for their product, which is what is happening now. They have a subscription model, etc., and people keep paying for it directly. But imagine, this was before UPI or any of these payment platform infrastructure was ready. So how do you take a call that there will be a payment infrastructure will be built, and because of that people will pay for subscription? There are too many sort of hoops to cross, right? But that's what you would have to do to be an early stage investor. You will have to be an extremely optimistic person to sort of invest in this category. Whereas for the other two asset classes, you don't have to be that optimistic. You can even short stocks. You can even be pessimistic in short stocks, right? Like you can sort of, but here, if you're pessimistic, there's no chance. You cannot be a good investor, like, because it's very easy to find loopholes for a company early on when you're evaluating it. Assuming, let's say your sourcing is damn good, you're getting all these good companies, but then you're finding faults in every company and saying no, and then you miss the one good company which could potentially return the whole fund for you, etc. So, and the third is the pricing. So what happens is, if you apply a lot of math and DCF and comparable multiples, etc., nothing will make sense. Because fundamentally, it's a question of how much money do they need to build a product, MVP, and sort of take it to customers, and how much do they ideally dilute given the number of founders they are. This is the math. It's not about what the company is worth on day one. So if there are 5 founders versus 2 founders or 1 founder, the amount of dilution that they can do could range from, let's say, 15% to 25%. If there are lesser number of founders, you could dilute 25% also, right? And how much money do you need to prove something? It depends on what you're building in the sector that you're in. For a consumer brand, it could be 1 crore or 2 crores. You get sort of some outsourced manufacturing, you put it out, either the product gets bought by customers or not. But for something like Pratilipi, where there is network, like unless there is a huge network already on the platform writing stories, the product itself will not matter. For that, you need a lot more money to kickstart. Therefore, they ended up raising $1 million as a seed round, right? So the math is on that. So now Pratilipi, let's say, assuming they diluted 20%, they'll get valued at 5 million. Doesn't mean they're worth 5 million on day one, right? So that's sort of the understanding and the thought process and sort of the comfort you will have to have as an early stage investor to do really well. So that's why, I mean, my experience also been in the last 8-9 years, it's very hard to be a great investor across multiple asset classes.
Okay.
You, based on your personality and your characteristic, you can be good at one or probably two things, but not necessarily across multiple spaces.
So if you have like a geeky, like fundamental approach that
Yeah.
you want to do things like these, you go to your public markets, your growth stage investing.
Yes.
But if, like you said, you wanted a little more serendipity in how you're doing things,
Yeah.
and a little more creativity, if
Yes.
I have to say that.
Yeah.
Growth stage is the,
Yeah.
I mean, early stage is the place.
Like someone who is part of our team now for the last few months, he's learning, so he plays drums for sure, but he's learning drums at the age of 32, just because he wants to, and
Yeah.
it's at the same time you could be doing other geeky stuff
Correct.
also, right? Like whatever works, but it's like you need to find some outlet apart from work, which will possibly lead to some serendipity at work also. I think that's something that you have to be okay with, rather than let's say trying to work 10-12 hours.
Yeah.
That will not lead to better outcomes
Got
necessarily.
But so while we're on the topic of the spectrum of investing, right, VC to PE to public
Yeah.
markets, I want to understand how much of private investing is just selling to the greater fool till it reaches the public markets, and the public markets maybe sometime rationalize the value.
Yeah. So when I left Spark Capital, this is sort of what they believed in, saying VC or private equity investing is a greater fool theory, and you keep jumping whatever, and then eventually IPO, etc. It is true to some extent, right? But when we come in, we truly believe that this could be a great opportunity that we are investing in. Now that the company can take multiple parts, right? Like either they do well and then they get capital. Sometimes they don't do well and they still get capital.
Yeah.
So then the greater fool theory applies. Someone else is buying into it when they shouldn't be buying into it necessarily. But what do we do at that point? Do we go to that investor and saying, no, this is actually a horrible investment, don't invest? No, we'll not do that, right? So neither of the founders do that. So to some extent, the greater fool theory does apply. But that's not the only thing necessarily. Like there is real value being created by a lot of companies, etc.
Yeah.
And the greater fool theory, sort of the other point is, what is the valuation of a company, right? Like what is the price or
Yeah.
what is the real worth of a company? That, like I've been at sort of crossroads for the longest time as to what is the right value. I read an article yesterday saying, oh, so many stocks are at 100x PE, like look at what the public market investors have done, etc. So what is it 100x PE? Who said the right number should be 30x or 40x or 20x? Like it's just a question of sort of demand and supply at the end of the day.
Correct.
For all prices. And so much of domestic SIP is happening, therefore all that money has to get into the same basket of stocks. The prices of those stocks will increase. That's it. It just because so much of SIP is happening doesn't mean suddenly 100 companies will list within 2 months. Companies can list only at a certain cadence when they are ready, etc. But if you look at it, probably in the next few years more IPOs will happen, and therefore money will go towards more opportunities. But by then the SIPs will probably be even much more. So 100x could be the new norm. If 100x stays on for a few years, then they'll say, okay, fine, this is a benchmark, and then 300x is very bad, 100x is okay.
Yeah.
So that's how I see it. Like I think the whole question on valuation, etc., is just a question of demand supply. It's so. However, whether some company is delivering real sort of value to some users, etc., is not debatable. That is black or white. That is tangible. That is black or white.
Yeah.
So if your balance sheet is good, PNL is good, then it's probably not part of the greater fool theory. Even if someone is, let's say, willing to pay a very, very high price, they probably imagine this could grow into much bigger 10 years. Like their investment horizon is just different from what you are thinking. That's it. Like if like some of our companies have got almost like 20x within just one round, etc. Of course, it's not worth 20x within 6 months of us investing, right? But they're getting that price because the investor who's coming in has a 15-year horizon, and they believe this could become 200, 250x. So he doesn't mind paying 20x now, whatever. It will still be a 10x multiple for him. So that's my view. I think greater fool theory exists to some point, but it's not like entire private equity in venture is just this.
So when you talk about greater fool theory, right, and like essentially making money, like exiting and making the final money, right, for the VC. how does your WEH at the end of the day make money? How much of it is management fees? How much of it is your carry? And how does that essentially structure?
So see, it's fairly structured in venture and private equity. There's a rule of 220. 2% of management fees per year on the entire AUM that you manage.
Okay.
And this AUM doesn't include like the value of the portfolio increasing year on year. It's about the cash that you've raised from LPs and you charge management fees on that.
The committed capital.
Committed capital. And once you start taking exits or you start taking write downs, then you subtract that from the AUM.
Okay.
Let's say I invest 3 crores in small case, but I've sold those 3 crores for whatever it is worth.
Yeah.
Then I subtract 3 crores from AUM and then charge management fees on that.
Okay.
So that is one, and that's usually during the entire fund life of 7 years, 10 years, whatever it might be, per year. The other component is carry, which is usually 20%, which is essentially called profit share in PMS, etc., where we have to deliver a certain hurdle rate. Could be 8% or 10% year on year.
What is hurdle rate?
Hurdle rate is the minimum return that we'll have to IRR that we'll have to give to the investors before which we can take our profit share.
So what is WH's hurdle?
Our first fund was 8%, second fund is 10%.
Oh.
So we'll have to give 10% back to the investors in terms of IRR. But after we give them 10%, the carry applies on the entire profit, not just above the hurdle rate. Let's say our overall IRR is 20%.
Okay.
And we deliver 10, our profit is on 20%.
20, not on the 10.
Not just the 10.
Okay.
So that's all. So it's called carry with catch up. Catch up is actually this concept of the whole profit, not just the eventual IRR minus the hurdle rate. So, but yeah, that's the other component. But that happened. This carry we get only when we actually eventually exit companies and send money back to LPs, and we cross hurdle rate. Only then the carry applies. So it can take 7 years from actually when you start launching your first fund to get any sites of carry. So it doesn't. It's like they call it. It's a gravy, right? Like it cannot cover any of your operating costs. All of that has to be managed using the management fee. Unlike public markets where you can just quickly sell, right? Like you can, or there is a real tangibility to the value of your AUM. So you invest in 10 stocks and after 6 months the value of the 10 stocks has gone up by 50%. You can actually exit at that day and get the entire 50% profit back and give it back to your LPs. So therefore you could even tell them saying on this notional mark to market sort of number, I will take my profit share of let's say 20% or 10% or whatever it might be.
But you can't do that.
We can't do that because it's all just notional.
Okay.
It's all just based on like I said, someone is paid this price, but they've paid this price at certain point in time. Now, if I go to them after 2 months saying, "Oh, you paid that price, take my stock at that price," they might not want to buy it. So that's why it's a little
there
notional.
in public markets because there is liquidity. You can do mark to market.
Yes, yes, exactly.
Okay. So we've talked about how money comes in, how money goes out, and how money is made. We want to talk about like just the industry specific about India really. So as we understand it, the point of VC is to stimulate growth in the startup ecosystem, etc., etc. And what we've been hearing and seeing, and correct me if I'm wrong, is that VCs or like big VCs, the newsworthy front pager headlines we see is that X is investing in some company which all cater to India one.
Okay.
So how important is it today to build for Bharat, which will maybe actually propel India's growth because building for India one is such a small fragment of the actual population, right? And how do you actually build for Bharat profitably? You can always scale in terms of users, but how do you switch on monetization and ensure that you're profitable at it?
Sure. So see, to your first point, I think there are more companies catering to India one just because of the monetization aspect that you mentioned.
Okay.
Because they are always readily monetizable if you provide them a product that they really want. It's the question of monetization doesn't arise, is only a question of whether you can find what they want and just serve it to them for India one. For the rest of India, Bharat, etc., before this financial sort of the payment infrastructure in place, this question of monetization, we did not know how could we monetize. Like a share chat or someone else, if you look at it, they just built millions and millions of users over so long. But how could you monetize them was not very obvious, because what did US do? They served ads. Facebook started monetizing, I think, within 3-4 years of sort of scaling up, right? We couldn't do that here, because what do you mean ads? If you serve ads to a vast population of our country, they are not going to click on it and buy something. Therefore, attribution to an actual purchase is not happening.
Right.
They might still buy it from the Kirana store. So therefore, ad attribution is not happening. Therefore, the value of and overall consumption for that segment could also be lower. Therefore, how much money you spend on ads is lower. So the money you could make on ads was limited, and it is not we are not a walled country. Like, I think Coup is a great example of what just happened. Twitter is existing in India, Facebook is existing, Google is existing. Google and Facebook together, the ad money spent on these two platforms is over 20,000 crores a year. So you have to compete with them in terms of attribution, in terms of targeting properly, and also in terms of user engagement and attention, everything. So that was a very, very hard game to solve. Then the other way of monetizing is actually selling some product or services where you're actually paying for it directly. That a product could be consumption, services could be digital services like digital content, etc., which has started happening only for the last 2 years, because everyone's on UPI and they don't mind paying 2 rupees, 3 rupees, 5 rupees, 9 rupees, 20 rupees online without thinking too much. With debit and credit card, this could have never happened. So that part is also now sort of solved for. And that, to your point, that's why there were not that many companies focusing on Bharat, as you called it, but now there are a lot more companies really thinking about these opportunities very specifically, because how do you monetize them is fairly clear. Now again, the problem is just to find out what do they really want and then building for them. That's it.
So we're wrong in saying that VC's attention is only channeled towards India one startups and not Bharat focused startups.
No, so I'm saying, like, now VCs are very open to all kinds of opportunities, because we have successes across all these segments, both for India one as well, for rest of Bharat as well. There are a lot of companies which have sort of been successful in doing something, and therefore it's not too much of a stretch to think that it could be replicable to more companies, and therefore investing in more companies, right?
So today, like, because of the ease to capital, ease to access capital has increased so much, founders are able to build companies much more easily. But with this greater access to capital, we are seeing even greater failures, right?
Sure.
You mentioned Coup. What I'm getting to is, how do founders today look at wealth generation by starting companies for themselves, right? Let's take the example of Paytm only, right? Despite existing for, like, say, 15-20 years, Paytm started making positive EBITDA now, that to some small amount. But in that process, Vijay Sharma has made a ton of money purely by his equity. So, how do founders in the future, or today that are aspiring to be founders, look at wealth generation in an equity-driven manner or a dhanda-like manner, that they're going to be generating money via cash flows of their company? So, how should they be looking at generating money through their companies?
Got it. Take you one step back. Why do you need to raise funding? You need to raise funding to either fund your P&L or your balance sheet. Either you have to be loss making, or you need to have a lot of fixed assets required or a lot of working capital requirement to raise capital to grow. If both of these conditions are not true, if you are a profit generating entity and if you can manage your working capital and balance sheet through debt, you don't necessarily need venture money to grow. So in most cases, this question of profitability will not and should not come till 5-6 years of a startup's journey, right? That's the whole point of venture. You're fueling some innovation which requires sort of early losses. And companies like an Amazon or Paytm, etc., what happens is you have a cash cow. If you had stopped doing it just that, you might have been profitable. Amazon is a great example, right? If you started with e-commerce, they stopped with e-commerce, they would have been profitable. If they stopped with AWS, they would have been profitable. But you don't stop there. So you increase the opportunity size and you become larger and larger as an entity, which is what I think Paytm is also doing. They've entered into so many different segments. And you have to think of each of these different segments as a startup within itself. And therefore, they will be loss making for the first 5 years, 6 years of that particular product, that particular segment. And that has to be funded. It will be funded by a mix of cash flows within the other profit generating part of the company, and also probably even sometimes external capital, right? I think founders getting incentivized through, I don't think they can ever get incentivized through profits. If they are getting incentivized using profits, it's easier to start a small business. You bootstrap it, you make money, you take all the money that you have. That's the right way to do it. But I think eventually, like, what does someone who's building a startup aim for is the market cap at the end of the day. Like, they'll assume that they'll get listed in 15 years and then keep growing the company. What do we talk about for all the largest companies in the world, whether it's an Amazon or Nvidia or whatever? Is all the market cap that's being spoken about, not the profits, right? We don't say, oh, Nvidia's profit is so much. None of us know what the profit is. And eventually they will obviously take some secondary shares, capital out. I think that's a natural sort of process, provided, and there is someone buying those shares, right? Believing that, oh, it will get even bigger, etc. So it's fair sort of market forces in play. So that's completely all right. What happens is, if you, let's say, we saw this a lot in 2021 and 22, there were a lot of founders starting up to quickly flip the company within 1-2 years. And saying, oh, I'll get exit, I'll sell my shares in Series A or Series B. That is wrong. It cannot be that short term that you start a company in 2 years, raise quickly Series A, sell your shares and then make some money. That's not a eventual sort of game which adds value to anyone. Whereas Paytm doing this after so many years is very different, after creating a lot of value to users, market, etc. Right? So the second part is what we also don't advise founders to liquidate very early, etc. Because without them, the company anyway don't run. We are investing in the founders. So therefore, they need to have enough skin in the game to continue building this for 10 years and more. But after some time, like we spoke about carry component for VCs, right? It's the same thing for founders. They have to take some liquidity in form of secondary shares, because their salary is not worth the opportunity cost of what they're doing. If it was worth, then they'll be employed at a very large company paying them crazy amount of salary, right? So then they need to be sort of given back in terms of secondary shares after building the company for a good amount of time. So,
but at some point, companies should fund their own growth, right? They can't perennially be just reliant on external financing.
Correct. That's what I said. Like, what happens is, after 6-7 years, you should have found a product market fit for at least one product within your company. That should be generating revenue. That should be generating revenue at a great margin for you to get positive cash flows for that segment. You could either grow that really well if you want to, or you can take that money, cash flows, and then invest in something else, like another segment, another product, etc. But I agree with you that it cannot be that if after 10 years also for your core product you're having to raise capital for it to work, that means something is not working.
But wasn't that the case for Paytm? After 10 years also, they were raising money for their core product to some extent, right?
Yeah, but they also expanded. No, they expanded to flights, they expanded to movies, they expanded to brokerage, they expanded to investing. Anything and everything you can think of is there on Paytm. So it was not just that, oh, it was a payments business and then lending. And during this process, they also had to go through so many different stages of regulation, of the entire infrastructure changing from a wallet to UPI and all of that will require money.
But because the ecosystem has been structured in such a way which says that, okay, you should grow for the first 5 years, profitably will eventually come. Do you think there are a lot of companies which are maybe big companies now that optimize for growth when their unit economics is never going to be profitable?
See, what happens is, one sort of aspect which I respect about public markets is, because it's the collective wisdom of lakhs and lakhs of people, eventually they'll push the company towards a certain path. Whether it is Paytm or Book My Show or any of the recently listed companies. If it is growth, it will be growth. If it is profit, it will be profit. and if they guide you towards that path, that sort of learning passes on to the other, let's say Series D, Series E companies,
Okay.
and then eventually to Series B and Series A, and then eventually to seed. Except that I think the point is not that you need to be generating profits at Series A stage.
Okay.
It's just that, like you said, the unit economics has to allow you, and there has to be a clear path towards profitability at least in 5 years time after you start up.
Right.
If the product doesn't work, it cannot mean that you keep raising venture dollars and sell something at a loss and keep doing that forever. Because, and that learning is now happening a lot thanks to the early companies starting to list, these tech startups starting to list online. And once they list, and then that public market sort of investors view is being passed on. Before that, we did not have this sort of knowledge. Like in 2017, what got listed? Nothing got listed. Like, so this, we just assumed something will happen in a certain way. Like this, let's say profitability will come in 6th year, but we didn't know for sure whether it will come in 6th year or not.
Right.
Like I gave you the example of Pratilipi.
Correct.
Who knew whether they could monetize, and then eventually what the unit economics will be, and then therefore profitability.
Fair.
So there are a lot of sort of leaps of faith that we take early on, but at year 8, year 9, if you still don't have positive unit economics, that means the product itself is not working, and most probably then you will not get funded. Who is a great example of that happening also. So now VCs also realize that. So they could have easily given more capital to fund that, but it doesn't happen anymore.
Right. And we're also seeing that VCs have, like that day we were speaking, Peak 15 has what, $2 billion in dry powder. So, like, what are you going to do with so much capital? Like, when will there actually be an opportunity? Like, even Zepto raised 700 million. I just don't understand, like, where are they using $600 million? So, one, what do you do with so much capital at a given point? Like, are you not tempted to say that, okay, this is the best opportunity out of all the bad opportunities we have, let's just take our shot?
That will eventually happen, and that's why you have bull markets of 21 or 22, right? Like, and a lot of bad opportunities will also get funded in a bull market. But VCs are now a lot more pragmatic, and even if that means a slower investment phase, they're okay with that. So whatever dry powder is there, it's just that dry powder will not get used up in 2 years or 3 years. It might get used up in 5 years or 6 years.
Okay.
And what is also happening is a lot of capital intensive deep tech opportunities are getting funded, whether it is chip making, space tech, deep tech robotics, all of that is getting funded, which have a much larger capital requirement, and also there is a lot of patience that is required for the opportunity to eventually work. So that is one. From a startup point of view, a lot of money, like Zepto in specific example, they have raised money just because, this is my theory, because all the other companies are either listed or part of large conglomerates and also this quick commerce is a one product in multiple products that they do have, right? From food delivery, or it could be Amazon or Flipkart, which do e-commerce, right? And I'm sure they'll also enter into this segment. Flipkart is already entering in a couple of weeks. Amazon might also be thinking about this.
Jio's also, right?
Jio also. But Zepto is the only company for them, this is their only lifeline.
Correct.
And therefore you need to have enough of, and what happens when instead of 3 companies which are right now playing in this space to 7 companies or 6 companies, there'll be more competition because they're all chasing the same audience like you and me. Then what do? There will be discounts, there will be a price war, there'll be something. So therefore, in order to keep a war chest to fight that, I think that's why Zepto is just raising more and more capital. Whatever they can get at a decent valuation, they're taking it.
Okay.
To see that that they win through this eventual sort of competitive part of this space. That's my opinion, at least.
So, and just continuing on that, like say in today's time, when founders are being so much more active by themselves, right, personally, online, how much of that is playing into the growth of a company? How much of the personal brand of a founder today matters in the growth of a company?
It honestly matters, like you said, this tier 1 India, whatever, it only matters to us. If forget you or me, if you actually speak to someone slightly older or slightly outside the circle of sort of work which we do, they will not know who Adit is.
Yeah.
or they'll not know.
Correct.
I mean, Deepinder probably now they're listed, etc. More people know of him. So I think it's a very small circle. I don't think it has any impact on the growth in terms of customers or product. It has some impact on funding because you're speaking to the audience which is on LinkedIn, which
Yeah.
are VCs, etc. So they'll see it, and it also helps in employer branding.
Okay.
Because then more smart people will want to come work
Sure.
with you for sure. So just on funding and employer branding, I think it doesn't have any impact on customers.
Okay.
Right. So, just another question I wanted to ask was, like, in the current market, was students, right, going into I'm going to my last year, he has 2 more years left. So, in terms of placements, I see a lot of buzz around PEVC. Oh, PEVC is the new thing. Everyone wants to get into PEVC, right? It seems like it's the new finance thing, it's the new finance bro thing. So I just want you to help us uncover what working in a VC really entails, and is it as finance bro as everyone thinks it to be?
No, it's not finance bro at all. Like I would say, it's probably a better fit for like creative folks.
Oh.
Like those who are into arts, etc., might succeed better at VC, just because, like I said, you need to be really extroverted. Because what do you do as an analyst in a venture fund? Your job would be to source the most number of opportunities.
Right.
Your job is actually not to necessarily evaluate the best opportunity, because there are people who can sort of guide and help you do that. But sourcing is where I think younger folks would have to do more of the heavy lifting.
Okay.
And for you to source, you either have to come from an existing network, or you have to be open enough to build your network. And for that, you need to be extroverted, etc. And therefore, it's not a bookish desktop kind of work at all. That is one. Second, I feel is like I was lucky enough to actually go through these experiences, and I never got an investing job on day one. Because first of all, it helped me understand what are the fundamentals of a business, right? Like I said, like eventually for startup, how much ever dreaming that you do, eventually it does have to lead to positive unit economics, positive sort of growth, etc., right? And that early learning of balance sheet and a P&L of multiple kinds of business sort of helped me understand what could be possible into, for a startup, and dreaming that. But without understanding the business and then you try to evaluate it, that's also very hard. Let's say you're really extroverted, you have an amazing network, you'll be damn good at sourcing. But on the evaluation part, you might still be lacking, because this will be your first job. And this is not an ideal first job, because what happens is, you could sort of be excited about everything, or you could be pessimistic about everything. Both are wrong. And if you do end up making wrong choices, it will affect your career directly. Meaning, you'll either push the fund to invest in companies which are not good, or you might have passed on opportunities which are damn good, which fund should have invested in. Both are sort of necessarily negative. And therefore, I think VC is ideally not a good first job at all, in my opinion. Like it's like you work somewhere else, you understand the fundamentals of a business, that will help you appreciate on the evaluation part. And of course, I think the longer you stay in any ecosystem, let's say you're really interested, you work in a startup, etc., you would have interacted with hundreds of employees within that startup. Those hundreds of employees will leave to multiple other companies, they'll build their own networks. And as long as you keep maintaining these network and relationships, in 2-3 years time, your network will be so much better that will help in sourcing also. Rather than starting at day one with a VC, where you're doing it more on a transactional basis, saying, oh, I need to find deals, who's starting up, that being the only thing. It will happen more organically and naturally if you start it after a few years. So I don't know if that answered your question, or if you had any follow up.
No, it does. But I just want to understand, you said a lot of maybe arts people would be good at VC, right? Why do so many tech people pivot to PVC, and why are they so successful at it?
So one is there are two kinds of investments that you can make, right? Like investments which are deep tech, and you need to understanding the tech stack more and more, and you are betting on whether that tech stack will sort of be a game changer for that company or not.
Right.
The second is understanding people and consumers, and then understanding what they want. Like for example, in our case, of a small case, it was not necessarily we didn't invest in the tech stack. We invested in the thesis that consumers want this kind of an investment product. They will pay for it, and they don't mind paying 100 rupees extra to invest in this vis-a-vis a mutual fund which is free. And that was our sort of bet, and we were right. But if you want to evaluate tech stack, engineers are probably better suited to do that. And all the more if you have learned, like let's say robotics, and then they're evaluating a robotics firm, of course they'll be able to appreciate what they're doing better. They'll be able to understand it faster. So that is probably just one. And second, more engineers actually end up becoming founders. Traditionally, not necessarily. I don't know what the percentage is right now, but just traditionally more engineers used to be founders. So therefore, if you've got a good college network, that sort of helps. So that's probably another reason.
I think that it's been a wonderful discussion, sir. I think in keeping time in check,
Sure.
We'd love to wrap it now.
Sure.
But thank you so much for that, sir. That was really helpful. That was really insightful more than anything. I think just for you to take the time out, really appreciate that. Lots for us to learn, lots of people out there to learn as well.
Sure.
We would probably structure this nice little report so that people can have it in a much more concise manner.
Awesome.
Yeah?
No, I'm glad. I didn't realize that 1.5 hours is done. So that means the conversation was
Yes.
obviously engaging and fun.
No, but I think for the first episode was pretty smooth, pretty interesting conversation we had,
Sure.
and hope this gets rolling with you as the first guest.
Awesome.
Yeah.
Thanks a lot for having
Thank
me.
you so much, sir.